Hi, good morning, everybody. Not sure about how to start this, but what I'm going to do is possibly just walk you through what we thought while we were building this business, and possibly that can give some insights on how possibly a successful wealth management business in this country can be built. I think when we started out in 2008, the largest question which came to our mind was, do we build a part or do we build a whole? Okay, and this was especially significant in terms of employee ownership versus participation in the business versus having a good platform. And this is a question which has kind of been on my mind ever since I started my career in the early 2000s. Even when I was choosing a firm or a platform to work with, uh, you know, back in those days, 2002, 2003, RM compensation was driven as a percentage of revenues. And typically, if you did 100 rupees, you ended up getting 15, 20, 25 rupees of revenues as incentives. There were a lot of firms which used to pay 35, 40%. There were firms which were paying 10, 15%, 17%, 18%. And that's when I started out my career in 2001. And by 2004 and 5, I figured out that the percentage is not important. The 14, 15, and 20, 25 was not as important as the 100 itself. And the ability to book revenue and get assets largely depended on the platform you represented. And therefore, if you were in firm A versus firm B or firm C or on your own as firm D, it could make potentially your earnings could be largely a factor of the 100 as opposed to a factor of the percentages. And sometimes as young relationship managers, we were driven towards deciding our careers basis whether one firm was doing 15, 20 or 25 rather than focusing on the 100. So when we really wanted to do something on our own in 2007 and wanted to get out, we were very conscious of this fact. And when we looked at our top 100, 150, 200 investors or 250 investors and said, well, will these clients do business with us? The answer really came out to be the following. We said the clients are going to look at the platform first. They like us, but they don't love us, okay, effectively meaning that they will do business with us and they will start with us, provided we are able to get them the same platform, okay. So it was very, very critical for us to be able to get to them what they required. And therefore, we started out IIFL Wealth in 2008 very differently, where we started out as a 2/3, 1/3 kind of venture, with 34% being owned by all of us employees put together and 66% being owned by IIFL. IIFL itself obviously was there within financial services for the last, I think since 96, 97, focused on retail brokerage. And over the 10 years prior to us coming in, had built a strong brand on retail brokerage and had a 1,000 to 1,200 crores book value, which allowed us to start off with an NBFC practically on day one under their patronage. So from a platform perspective, IIFL was getting us an NBFC, it was getting us research and a brokerage platform, which we could capitalize and take to our clients. And from our perspective, we were getting the relationships and the ability to deliver the proposition to our clients. And therefore, it became extremely critical for both of these to mash along. And a lot of people asked us over the last, now it's been 9 years, do you regret having not done this all by ourselves? Okay, should you guys have gone on your own? I think the answer is no. Okay, if you would have gone out totally on our own, the story would have been very, very different. Most probably, we would have got diluted many times over. We could possibly own not more than 20, 25% of the business today, and the business would not have scaled up to the same extent which we have scaled up today over the last 10 years. So I think one important lesson which we learned over the last 10 years as we build the business is sometimes the part is as important as the whole. Okay? The whole itself is not always important. So a focus on how to get to the entire 100 or how to get to the client's interest first in terms of delivering the proposition will be more important than our interest itself. So in retrospect, I think what we learned is the platform has to be 100% accurate. Okay, that is something which cannot be sacrificed on. And what comprises the platform, and what will make up the platform for people to kind of believe you, trust you, get them to handle your money. Three things made up the platform very, very critically for us. One was people, second was products, and third was the proposition. Okay, and all these three things needed to come together for it to succeed. People was very important because our industry has been plagued by multiple amounts of attrition over the last 7 to 8 years. And when we looked at people, we realized people want 2 or 3 things. Okay, the first thing people want is every relationship. I've been a relationship manager all my entire life. I'm still pretty much a relationship manager. What relationship managers want to do, irrespective of what their compensation system is, they want to go home and sleep well. Okay, they want to believe, rightfully so, not believe. They want to believe that they are doing the right thing for the client. Okay, at all points of time, that is what they want to carry home. They understand that at the end of the quarter or end of the year or end of 5 years, their incentives are going to be a function of the revenues, but nobody does that kind of mis-selling. Everybody wants to do the right thing. Okay, therefore, naturally, relationship managers get attracted to platforms which are doing innovative, right stuff for the client. Okay, so it's like a catch-22 situation. You attract the best people when the platform is equipped and strong enough to attract the right people. People want to get attracted to platforms which are doing the right set of things for the client. Second thing people were looking at, they were obviously looking at transparency and employee ownership. Those were aspects which allowed them to be able to have a longer term alignment of interest with the firm as opposed to having a shorter term of, shorter interest in terms of the compensation structures. So I think from a people perspective, transparency, both in terms of their linkages to the business and having a superior platform was very, very important. Products required a massive investment. Okay, so like pretty much for us, we look at products as a factory. Okay, so factory of machines. The only advantage is that the great people who manufacture innovative products for us are not depreciable machines. Okay, so they're non-depreciable machines. And obviously the relationship managers outside are like a set of salespeople who are kind of taking out the manufactured products. But even though we are a wealth management unit, our product setup needs to be practically like an asset management unit, where we've invested substantial amount of resources in building expertise across every asset class, whether it's fixed income, equity, or real estate. And today we would end up as a firm spending possibly 50 to 60 crores just in terms of salaries on the product team itself. And specialize on all the 3 categories, whether it's fixed income, equities, as well as real estate. So I think products is something which requires an investment, and you really can't build a successful business which will reach out to multiple set of clients without having the right set of products. And products again is, it's passe. In our business, there's nothing called a patent or a copyright. Practically every product can be copied in 7 days, 10 days, 15 days. There's no copyright really. So therefore, the onus to try and innovate on a quarter-on-quarter basis even becomes higher and higher. So when you say products, it's not only about a standard product, but the innovation on top of the product becomes extremely critical. And therefore, people versus machines make a big difference in terms of ideating the product itself. The third thing is the proposition itself. Okay? I think from a proposition perspective, again, you need to be very, very sharp. There are 3 things in the proposition which I think a client requires. He requires a good research team, okay, across asset classes. He needs a good platform to execute. Okay, so your brokerage desk should be very, very strong from an execution perspective. And when I say a brokerage desk, today execution of direct stocks, mutual funds, everything can be pretty much done on the brokerage platform. So when I'm talking about execution, I'm not only talking about execution of a stock, but execution across all asset classes. And thirdly is the NBFC or the non-banking financial corporation to support the funding needs of a client. Today, if he's invested in FMP and he needs some bit of liquidity for a month after 2 years, you can't go and tell him, hold on, I don't have the ability to fund you. I'm going to go out and figure out another NBFC or a bank from where I'll arrange the loan. It's not that simple. So from a platform or a proposition perspective, all these 3 things need to necessarily come into the fold. So in a sense, when we thought about our private wealth business, we thought we need the right platform. Then we got into saying, what is the platform made up of? The platform was made up of people, products, and the proposition. How do we get the people right? By giving them a transparent structure to work in, giving them some bit of employee ownership. How do we get the products right? Again, investing in people, having a great innovative approach. And how do we get the platform right? We get the NBFC research and the brokerage team all in place. So if it was so easy, why can't we all build private wealth businesses? It is so easy. The only challenge is we need all these 3 things to happen equally at the same point of time. Okay. And I think if we can get all these 3 things to merge with each other, at any point in time. I think we can all start a private wealth firm tomorrow. Okay, it's as simple as that. But all these three things need to happen together. And unfortunately, because the market is so competitive, all these three things become multiplicative as opposed to additive. Okay, so what I mean to say is, if there are two firms in the market and one firm's really at, let's say, scoring 9 on 10 on all these three aspects, and there's another firm scoring 10 on 10 on these three aspects, when they actually meet a high net worth client, it's not as if one firm is scoring 30 on 30 and the other firm is scoring 27 on 30, and the gap is only 10%. It gets accentuated to such a margin that one firm looks like 1,000 because of 10 into 10 into 10, whereas the other firm looks like 9 into 9 into 9, which becomes like 729. So the score of the next firm looks 30% lower, okay, than the other firm. So it's extremely important to have all these three things. But if you have all these three things and you can keep it all three in place, I think there is enough reason for all of us to believe that we'll do extremely well. And I think we've had examples of at least 3 or 4 good private wealth firms over the last 10 years. We've had examples of 3 or 4 good independent financial advisors who've done extremely well. And I think the common thread between all these people who would have done well would be these three. And similarly, firms which have not done too well and possibly exited from the country possibly did not get one of these three things right. And really, this for me is practically the cornerstone of our business, because otherwise the cups and coffees with the clients will only keep going down on a daily basis. Our relationships will be valuable, but they will not be valuable to an extent where the client continues to do business with you on a week-on-week basis. So from a big delivery point perspective, I think this is the most critical portion in building a private wealth business. Second, I think you need to block out the noise a bit. Okay, there's a lot of noise, a lot of things, a lot of thoughts. At the end of the day, delivery is most important. And the world on Monday is much starkly similar to what it was on Friday. Okay, we like to believe it's not, but it's much more similar. So I think what in our business, I think it's a much more laborious business than what people think. Obviously it's intellectual in terms of putting things together, putting a lot of innovation, but it's laborious because we're dealing with money, and people love money and they want to spend time on it, especially the first generation entrepreneurs in India. We're still not dealing with third generation entrepreneurs in Europe, where they have kind of a hands-off approach to money. They still have a very hands-on approach to the money. And therefore, as relationship managers or as people who are handling that money, we need to practically be engaged with them on a week-on-week basis. And if you engage with them on a week-on-week basis, they might not be doing too many changes, but they want to hear from you. Therefore, it ends up being quite laborious. It ends up requiring us to put a lot of hard work as opposed to only intelligent work. Okay, so I don't think so. In a sense, our job becomes quite laborious, and it requires a fairly, if I can put it for the lack of a better word, very good commercial sense. Okay, so everybody who's dealing with it needs to like money or likes dealing with money. Okay, so you may not know your integrations and differentiations very well. You don't need a great MBA degree, but you need to be able to multiply and divide quite fast, right? So you should be able to add fast. You should be able to multiply, divide fast. So commercially, you should be smart. Okay, I think being commercially smart, be willing to put in your number of hours and have an appetite for liking money are skills which are going to be quite critical in kind of setting up our business. And I think last of all, in terms of getting the picture right, I think as a firm you have to, today we are in an era where I think we need to be I think three things for sure. We need to be modest, we need to be client-centric, and we need to be humble. Okay, modesty is a factor in what you are trying to get to the client in terms of returns, because at the end of the day, today, getting anything more than 11 to 12% on a consistent basis will eventually become suicidal in some way or the other. Because there'll always be a difference between creating wealth and managing wealth. We definitely don't come into the first category. We come into the client's life in the second category, after he's finished with the first category. Okay, so we can't start creating wealth for him by managing it on a remote basis. So we need to be modest about what we are promising. We need to be modest in our expectations, in his expectations, and ensure volatility is the least. But given where we are as a country, I think 10 to 12% on a CAGR basis is still pretty much possible. Secondly, we need to be fairly humble. Okay, the moment we kind of lose our humility, that's where the problem starts, because our ears become closed, our eyes become closed, and sometimes for years we don't see change in regulation, we don't see change in what the client wants, we don't see a change in the delivery model, and before we know, after 2 to 3 years, our business model practically becomes extinct. And third, in a world which is as transparent as this, client centricity is going to be absolutely critical. Today, you can give as much returns as you want to the client, but if he feels that you were not transparent with him, then it's going to be a real uphill task to get back the relationship you already lost. Okay, so I think transparency is going to be very important, and client centricity is going to be important. So from a value perspective, I think modesty, humility, modesty, client centricity, and simplicity, all three are very, very key words we need to kind of carry back. So I think on a combination, I would kind of put these three big words possibly to sum up as to what would be needed to create a successful private wealth brand in India. I think one, you need to get the platform bang on. Okay, so no sacrifices, no compromises there. I've already discussed the components of the platform. Today they require a big investment, but all of them need to come in place. Second, you need to get your people right from a mindset perspective, both strong commercial interest and ability to put in the number of hours required by the clients. And third, you need to get your values of modesty, simplicity, and client centricity in place. I think if you can get a mesh of all of these three, the good news is the volumes are only increasing. Margins are always under pressure. There is no business in the world in the last 50 years where a scale is increasing, number of entrants don't come in and margins don't go down. Okay, margins have to go down. They'll either go down because of competition or they'll go down because of regulation. Okay, so that's a given, right? That's a given. But the good news is volumes are increasing. Okay, we are not in a cycle which a brokerage business saw for the last 8 to 10 years, where the size of the kitty itself fell down by 70%. Okay, so even if you were the largest within the largest and you continue to be the largest within the largest, still your revenues were going to shrink in a massive way. We are not in that cycle. Our volumes are still growing. Number of people coming into money is still very, very large. Margins will shrink, that's a fact of life, but there is enough economic sustainability to the business, at least for the next 10 to 15 years, provided we can get the first three right. So really, I think the ball's in our court. I'm not that pessimistic about this business at all. I think we are very optimistic. There's massive volume growth, and irrespective of the small skirmishes which come through on mutual fund distribution, direct code, and so on and so forth, I think there's a long way to go. And I think it's an industry which is only going to grow from here for the next 10 to 15 years. So thanks, I'm happy to take questions. Yeah. So I think the platform, as I said, has got three aspects, right? One is the product team, the second is the NBFC, and third is research. Okay, I think all three are and quite expensive. Today, a product team, in my mind, for a full-fledged private bank of our size could cost anywhere from 40 to 50 crores a year in terms of salary cost plus other costs put in. NBFC, typically my experience is clients end up borrowing around 3 to 5% of the assets you manage. Okay, so if we advise clients over, let's say, 80,000 crores of assets, they could typically end up borrowing 2.5, 3,000 crores from us. So 2.5, 3,000 crores if they have to borrow, we need capital of around about 10% of that borrowing amount, which is then 250, 300 crores. And third, research is another 10 to 15 crores. So effectively, if you're asking me in terms of a dollar value, I think on a constant basis, you need around about 10 to $15 million of spend a year constant basis. In terms of equity raise, you possibly need to raise 30, 40, $50 million of equity. Having said that, therefore, there are massive number of boutique advisory firms across the world which have emerged as external asset managers on large private bank platforms. Okay, so today UBS, Credit Suisse run EAMs which are practically as large as some of the private banks. And the EAMs, instead of spending this amount of money on these three aspects of the business, are basically sitting on the UBS or the Credit Suisse platform and utilizing it. So yes, if you want to become a full-fledged private bank and service clients of that size and scale on a consistent basis and make it scalable, I think that investment is required. Otherwise, over a medium to long-term basis, in India, you still don't have great EAM platforms. But I guess over the next 5 years, they'll come around. And then, mid-sized individuals and institutions will be left with little choice but to become EAMs on these platforms. And we strongly believed in this, and that's the reason we went for instead of going out on our own, we did a 66-34 with IIFL to begin with. Yeah. Yeah. See, product innovation can happen in multiple ways. It can happen on composition, concentration, fee structure, timing. It can be a host of many things. Okay, I'll give you one small example. For example, we've done a structured node in 2008, May 2008. I'm going back a long time. Nifty was 4,835. And as distributors, we basically used to get 1% a year as inbuilt commissions for creating these products. So at that point of time, I remember the most popular product was 1.5 times the upside of Nifty and downside capital protected. Okay. Now, effectively, what was this doing? This was putting in around about 75 to 80 rupees into a deep discount bond, which was growing to 100 rupees. And the remaining 22 to 25 rupees was going to buy a long-term 3-year call option, which was basically giving you the 1.5 times upside on Nifty. But the 3 rupees of commission, which was being paid to the distributor, which was, let's say, us, was effectively coming out of the 22 rupees immediately, because 78 rupees was going to the bond and 22 rupees was going to the option. So effectively, the participation was dropping to the extent of nearly 25% because of the upfront. Okay, so we launched the same product under the non-discretionary PMS format, and we charge the client a 1% fee every year, okay, instead of charging it or inbuilt receiving it from the manufacturer. So instead of 1.5 times Nifty, the client was getting 1.8. Okay. So then we suddenly mispriced the market totally. Now, client who was coming in to invest, he was not bothered about necessarily paying 1% a year extra for 3 years. He came in expecting the Nifty will at least grow by 10% a year, right? Now, suddenly instead of getting 1.5 times, if he's getting 1.8 times, it makes a big, big difference. Now, we collected the largest ever 250 crores we collected on a single day for that product. Now, that happened purely because we mispriced the market. Is that copyable? Is that patentable? The answer is no. In 15 days, somebody else did the same thing. But for that 15 days, you obviously have a advantage to take the product to the market. So it can be small tweaks, and there are millions such tweaks, and you practically have an innovation center which on a quarterly basis sits and innovates. I can walk you through many examples, but it might be some small things like this. So basically getting deep into the product, understanding what's happening and tweaking it to make it more client friendly and different from what's there in the market. So basically taking advantage of anything which is mispriced. So there is an inclination of a distributor to sell a product if he receives more upfront. Therefore, the product is mispriced. So we don't have any big bias of receiving commissions upfront. So we can remove that mispricing and make the product more attractive.
Very good morning, sir.
Hi.
Wealth creation and and wealth management. These are both different functions.
Absolutely.
Which you think is the most important function of the whether wealth creation is there or wealth management?
From whose perspective, sir?
Huh?
From whose perspective?
From customer, from the client.
From client's perspective, definitely wealth creation. So if you have a good business in mind where you can deploy your capital, barring the requirement to diversify your risk, there should not be any requirement for you to have any money in wealth management. All your money should be in the business. Okay. There's nothing like your own business, because at the end of the day, the ROEs on your business today can still be in the region of 18, 20, 24% on a post-tax basis. So on the capital which is blocked in the business, you can still get 20 to 24% ROE. Today, to sustainably get 20, 24% ROE by investing the money is going to be practically impossible. It's just not feasible. You'll possibly end up at 9, 10, 11, 12 in different years. So if you have a good business idea and you're willing to put in your hard work, labor, and take the credit risk, then definitely creating wealth by doing your own business is a much better enterprise than managing your wealth. So if let's say a 30-year-old inherits 100 crores, what would be the advice? To just sit around and manage it, or get out and take 80% of the money and try and create a business out of it? The answer will always be on the second one as opposed to the first one.
Why are you raising capital? Sorry, thanks. What's next, Karan? You've raised some capital.
Yes, we did.
Do you think one, is a global platform necessary? I mean, you didn't have one, or are you trying to build one right now?
No, so I think raising capital is a natural kind of a movement, because when we started out, we basically, as I said, the NBFC is a key requirement in our business. And for the first 7 years, we had thought to ourselves that we will build this business to a scale at least for 7 years. And before that, we won't raise capital. Because if we go out to raise capital prior to that, we won't get a decent enough valuation. But requirement of raising capital has been there from day one, because at the heart of it, we are been using capital to fund our clients from our parent NBFC. Okay, which is the IIFL NBFC. And obviously IIFL has multiple different shareholders, and cross pricing comes into play when we fund our clients. And typically our funding to clients is at 11, 11.5, 10.5%, because the risk taken to give that credit is very, very low. For IIFL, they are more or less more in the mortgages business, developer loans, and so on and so forth. So effectively at that point, funding clients at 10.5, 11, 11.5%, without a commensurate private banking fee income really doesn't make sense. So at some point, we needed to build our own NBFC and fund our own clients through our own NBFC. So the idea of raising money from General Atlantic was only to create our own NBFC. So the entire 900 crores which is coming from General Atlantic has been put into the NBFC. And we had around about a 2,500 crore funding book to our clients from our parent NBFC, which we've just moved to our own NBFC. So that's really the context of raising capital. From a global platform perspective, we've been there in businesses across the world already. General Atlantic really, from a management perspective, doesn't get involved on a day-to-day basis, but they obviously act as connectors for us to a lot of the US institutions, because they've had massive coverage in the US market. Yep.
Request to take the questions outside. Start with the next.
Great. Thanks. No.